Good afternoon and welcome to our Financial Advisor Forum. I'm Greg Greenberg from The Street, and today my guest is Portfolio Manager Gene Gard of Dupree Municipal Bonds. He's here to tell us about investing in Southern State Muni Bonds. Welcome, Gene.
Hey, Greg. Thanks for having me.
Okay, you run municipal bond funds for the states of Tennessee, Mississippi, Kentucky, North Carolina. How are the Southern states doing economically?
Yeah, my colleague and I, Vincent Harrison, we manage in those states, and they're actually doing pretty well. You know, we monitor things like income tax collections and sales tax collections, and over the last few years, we're seeing, annualized maybe 3-4% rises. It's a little choppy, but, things seem to be on the right track in most of the states where we work.
And what are the differences between those states and the rest of the country? The yields on your funds generally are around a little bit over 3%. I think the National Muni Bond Fund, the MUB, which is the ETF everyone watches, the yield on that is a little bit lower than 3%, probably 2.7%. So how does your region stack up with the rest of the country?
Sure. Well, part of it is we have some opportunity to get involved in different parts of the curve, and maybe our funds are a little bit longer than the index or than the MUB, which gives us a little more yield.
Right, duration counts.
Yeah, sure. But then also, our states, even within the states, there's a wide variety. There's very highly rated credits and not so high rated credits. So we try to find the sweet spot there, and we think there's a lot of opportunity as compared to some of the more frequent, maybe more liquid issuers like the Californias or Illinois. There's been some challenges there, political and otherwise, and we don't see as much of that in our states.
Well, there's certainly been blow-ups everywhere. One state where you do manage a lot of bonds is Alabama. You have your Alabama fund. They had the Jefferson County blow up with their sewer bonds. They're actually selling more sewer bonds from Jefferson County. I think $1.7 billion worth of sewer bonds. How do you avoid those?
Well, that's a great question. We are very plugged into that because we have an Alabama fund, and the answer is that these blow-ups we're seeing, like Jefferson County or Detroit, we've been very fortunate that most of them are not acute events. It's very long-term processes that unfold over years. So in the Jefferson County case, we did hold some Jefferson County bonds, but we were able to sell them not only before the bankruptcy, but before they really even started trading at distressed levels. So,
are you going to buy back into the new bonds that they're selling?
Well, right now, we don't put all our faith in the rating agencies, but this issue is very much on the cusp of some of it's investment grade with insurance and some of it's not. So it's not appropriate for our funds at this time, but certainly we feel hopeful that things will improve and maybe we can get involved someday again.
Is it appropriate for a New York Yankee like myself to buy Southern Muni bonds? Is it worthwhile?
Sure. Well, there's, as you mentioned, there's a lot of political risk in some of the bigger states, and certainly there's challenges everywhere, but we feel like there's a great risk-reward profile in our states. And we also do have a national taxable muni fund where we actually have sort of an overlay of avoiding the more prominent states and focusing on the states we're more familiar and comfortable with. So absolutely, just because you live in the big city doesn't mean you can't get involved in these bonds in other states, and in fact it may even be a better opportunity for some investors.
All right, thanks a lot, Gene. Sure. And thank you for watching The Street's Financial Advisor Forum. From New York, I'm Greg Greenberg.